Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with Greg Weldon, who is an author, commodity trading advisor, and also a publisher of research and advisory services for institutions and retail investors. Hey Greg, thanks for joining us. How are you doing today?
It's my pleasure. Thanks for the invite.
Yeah, well, thanks for taking the time. I want to start off and just get your take on the metals right here and now. I don't want to make too much of the day-to-day action. I mean, maybe I am, but to me, they've been so close to breaking down in the last week or two. We haven't seen that yet, so could we potentially be seeing a bottom develop here, or am I just reading too much into the day-to-day action?
Well, I don't think you're reading too much into the day-to-day action. The day-to-day action is interesting. I think that you can note the number of times we have touched below 1550, really dating back to September of last year. And you see on a daily bar chart the tails that are left behind when you get buying that seems to materialize between the 15 and a quarter and 1550 level. It's very noticeable to me that this is a very hardcore band of support that is being generated by some demand out there. Wouldn't be surprised if that demand were official in nature. I think that the last thing that global monetary officialdom wants to see right now, when they are really not pumping money, when inflation is falling faster than they have an ability to cut rates, when you have the macroeconomic situation, particularly in the core of Europe and Germany and in the U.S., rolling over again to the downside. That when they are kind of boxed in politically in the U.S. specifically, I don't think they want to see gold break down. I think that would be a signal that they would not want unleashed into the markets, particularly as it relates to equity markets, which are teetering technically in most places outside the U.S.
Yeah, that's an interesting point there. Since you touched on Europe, obviously it seems like that's a huge cloud that's hanging over the markets in general and specifically gold and silver, of course. Do you see any possibility of Europe taking any major action before some kind of panic or crisis develops? In other words, is it most likely that ultimately they'll be forced into something by the markets?
Yes. Yes, they will be forced into something. And no, they won't act until they are forced into something. And I think the bigger picture question that you're kind of asking really is, is there a way out? And frankly, in my mind, it's a lose-lose situation unless something dramatic happens. And by dramatic, I mean changing the law surrounding the European Central Bank and giving them some flexibility to actually print money to buy sovereign debt, to take it off the market the way the Fed has done with Treasury debt. I don't see that happening. I think Germany's objection to that will remain in place and will continue to be stiff in its vote against that kind of activity. So people talk about kicking Greece out and resurrecting the drachma. Clearly, if you do that, you need to resurrect the peseta, the scudo, right on down to the French franc. Ultimately, I've offered the thought process that maybe a solution, and there's no solution, so I hesitate to use that word, but maybe one thing they could do that could actually have an impact would be to kick Germany out. Let them resurrect the D-Mark, let them go back to the Bundesbank, let them have their hard currency policy, and let the others basket themselves against the D-Mark and allow them to remove that that resistance to the ECB potentially buying more debt. And against the Bundesbank, now you have the ECB, which would be it would be taken down a notch in terms of its Bundesbank likeness. And that might be one thing. It would also the currency adjustment that would take place, the euro would fall relative to the D-Mark. And I think fairly quickly and substantially would be some rebalancing of the trade dynamic as well. The problem with all this is you have a macroeconomic decline unfolding in Germany. It's rather severe. You can't deal with it with normal monetary policy. They've cut rates already. They're expected to cut again. That wouldn't be a surprise. You need something more. Are they going to do something more? Probably not. Not until they're forced to. And then probably what they do won't be enough because that's been the 2.5-year history of this crisis. I don't see that changing. I see this thing being dragged out, worsening, getting deeper, more economic downside. I see more pain.
Let me just follow up on that. Can you kind of discuss the interplay between, I guess, the economies in the ECB and the credit markets? I mean, we know that the credit markets, they're generally a leading indicator. I mean, um, but I mean, is it possible that the worsening economic situation there can be a catalyst for even more stress in the credit markets? I mean, could you kind of discuss what's going on there between the credit markets in Europe and also the overall economic situation?
Well, yeah, what you said is 100% true. I mean, you have a situation now where you've morphed this from a sovereign debt crisis into a political crisis. Okay, so that's your second level of crisis. Third, a macroeconomic crisis, which is unfolding rapidly. Okay, and fourth was the potential for banking crisis. Okay, you removed number four. That does nothing to address the other three. The macroeconomic crisis is severe, and it's getting worse quickly. And we got data this week from Italy and France that showed their deficits are worsening because they're still spending more. In France, for example, they used the excuse of an increase in revenue to go out and spend twice as much of an increase in spending as there was in revenue. So you really have no austerity taking place yet whatsoever in Italy or France, worsening budget deficits. And if you take GDP down, you take growth away, let alone you get a contraction in GDP. What it does is worsen the ratios. You're taking, your denominator. It's debt and deficits to GDP. You take GDP down, it's going to make the debt and deficits look even larger, which is going to impact the bond markets. And what I find really mind-blowing when I look at, some of what officialdom is doing in Europe, particularly this is true in Italy, where they have longer-term debt that they don't want to roll over at the yields that are, currently exist. They don't want to roll over stuff coming due that they have to, they're taking it in at 3%. They have to put it back out at 6.5%. So instead, what they're doing is issuing shorter-term debt, 182-day bills, 1-year bills, and essentially still stuffing this thing into the, they're shortening the time frame into which this debt is going to all kind of begin to converge in its maturity. So really, I think it's very interesting to note how this dynamic's playing out. Not so many people talk about it, how this is setting us up for a bigger problem 6 and 12 months from now, potentially with even higher yields, across the board as the macroeconomy declines. I mean, I don't see an easy way out. The other solution being bandied about, the one that France is pushing for, would be a rollback of austerity measures to try and take some of the pressure off the macroeconomy. And while that's all well and good to take some of the pressure off the macroeconomy, and maybe at best they can establish some equilibrium, the problem with all of that, of course, is the rollback in austerity also is negative for bond markets because essentially, it's a lack of fiscal responsibility. So it means more debt because they're going to spend more. They're going to cut back spending less. They're going to, roll back tax increases that were designed to increase revenue. They're going to do all these things, hurts the budget dynamics, hurts the bond markets. Either way, it seems, unless somehow, they manage to work a deal with Germany going off on its own, or the ECB being able to monetize debt without sterilizing, the end game. It's a lose-lose situation in my mind.
Okay, well, let me ask you another follow-up question, maybe kind of difficult. So from what you're saying, I mean, it seems like the risk of what's going on in Europe, just everything, they're spiraling out of control as far as the next 6 to 9 months or so. It sounds like the risk is increasing. I mean, at what point does the situation become bullish for precious metals? I mean, could they kind of develop a bottom and maybe turn up a little bit in this process before some major action arises? I mean, could this situation just get so much worse that it becomes bullish for precious metals rather than the fact that it's deflationary and that it's bearish?
Yes, it could, and you might even ask yourself, is this the reason gold is not breaking down when other things have to some degree? I don't necessarily buy into that. It's an interesting thought process. It becomes bullish when there's a response. I don't, or the other thing I would look for here, when it could become wildly bullish from the perspective that you're driving at here, which is a flight to safety because no one feels safe in anything. If the dollar, I mean, the problem right here, of course, is the euro is depreciating against the dollar. Dollar's rallying. That's not positive for gold necessarily because it is deflationary. And the dollar's rallying because nobody's reacting. Nobody's monetizing debt. Nobody is using monetary policy to debase their currency right now. When that changes, or if it changes to the degree that the U.S. comes to the same kind of scrutiny, which could easily happen in August, in second half of this year, beginning of 2013, U.S. has its own sovereign debt problem that is very real, tangible, and staring us right in the face. So if you get a sense where all of a sudden, the dollar's not a safe haven because the U.S. is in the same boat as Europe, that could be wildly bullish for gold. Or you get a response from the European Central Bank where they somehow, manage to work some kind of magic again, where they are freed up to, put money to work that, essentially is created from, some respect. Having said all that, I don't see that happening anytime soon. That's the problem. I think when you talked earlier about the breakdown look to the metals, yes, we've held this 15 and a quarter level, but the time we've spent gyrating here between 15 and a quarter and 1650, the technicals have worsened. And a lot of the stuff has rolled over. Moving average has crossed to the downside. Trend lines have been violated. The long-term chart, the 52-week moving average has been violated, has rolled over. There is a lot of technical negativity here, where if you do break 15 and a quarter, and if it is on the back of breakdowns in European stock markets, predicated upon a lack of action from officialdom, and this is the way I see it playing out, it's going to be hard to see gold holding up at this 15 and a quarter level. I think it has to break first before it's, another, buy of significance.
Right. Now, just a quick question to go back to what you were talking about. Is there any chance that the Fed could act before we see action from Europe? In other words, obviously we have some mounting problems here with the economy and, all the debt we're going to have to monetize in the future. I mean, is there a point, because we know that Europe is slow to act, is there a point that what's going on in Europe exacerbates the overall situation in the U.S. and then the Fed? I mean, there's a chance that they could, just decide to forget about the ECB and say, okay, we have to come in and do something.
Absolutely. I think that'll happen. I mean, I think that it will be, onus back on the Fed. Once the political situation here in the U.S. gets clarity, I think the Fed will be, ready to push. The question becomes, how and how hard. And, if it's going to be just Operation Twist, it needs to be more than that. Of course they're going to want to flatten the yield curve. The long end of the yield curve is the only place there's any juice left, kind of in the U.S., structure to get some stimulus. It really is. Beyond that, it has to be purchases of assets. So it'll be interesting to see how that plays out, whether they, kind of skip this next, Operation Twist extension, the promise to do more. It's not a lot of bang for the buck relative to outright purchases of some kind of securities, whether it be treasuries at the long end or other securities, or God forbid, even real estate. I mean, to whatever degree the Fed has a lot of options, and if they want to get creative and they want to get aggressive, they can. And Bernanke has shown a willingness to do that. And when they are staring at deflation, they will do it. So, this is where, longer term, we think gold has new highs in the next, say 2 to 4 years. I absolutely would envision a scenario where, gold could break down here, wipe out some of the last of the party, and then the Fed comes back into play. Things have deteriorated. The problem is things deteriorate in the meantime. So getting to that point is like what I'm looking at right now. This is on my radar screen for the next, 2 months, let's say 2 to 4 to 6 months. Beyond that, I think there's going to be great opportunities at lower levels based on all of what we're saying here. And yes, absolutely predicated and focused upon the Fed.
Now, Greg, what do you make of the fact that the S&P is the only risk market essentially trading near its highs? I mean, would you consider this situation? I mean, I don't want to reference everything back to 2007, 2008, but could it be a little bit similar to how strong the S&P was in the fall of 2007?
I mean, I think it's a function of, people have run out of other places to put money, for one thing. Dollar has been strong, makes it an attractive candidate. There had been a period where the pop media had a lot of people believing that the economy was going to take over from the Fed as a driving force, and that the economy was going to be strong enough to produce profit growth that was going to generate higher equity values. I think that is being dismantled as we speak, that thought process. I think that the flow out of other equity markets into the U.S. may have run its course to some degree. I think that the U.S. macroeconomic situation looks problematic from here going forward without any support from labor. The labor market is a nightmare. It's in crisis. You can say whatever you want. It is getting worse. Every month we see a new report. The U.S. labor market worsens. Housing, at best, is sideways. Pickup in construction, yes. Is that necessarily good when you have an onerous amount of supply already? This is supposed to be a positive. That, home builders are experiencing a good run here because they're building more homes. I don't see that as a long-term positive. I don't see anywhere where wealth inflation is going to, be resurrected in the housing market. Not happening. Wage inflation in the labor market, not happening. So without these things, it's very problematic to see, how we get along, without the Fed in terms of the stock market. So I think that this is the next phase. And I think this is one reason why the Fed has, been able to avoid actually acting. Because guess what? Stock prices are not coming down that hard. So they're going to hold these bullets in reserve until they really need them. And I think this is, stock market will ultimately be a catalyst for the Fed to act. So I see risk here in the U.S. stock market, even though it has held up better than other markets. Other markets are breaking down, and upside leaders even beyond the U.S. And frankly, some of these are in South America, for example, places like Chile, Colombia, Mexico. They also, outside of Mexico, Chile and Colombia being two prime examples. Peru is another one, where they're breaking down. So they're closing those spreads, having outperformed not only the U.S. but vastly outperforming Europe. But now they're showing signs of weakness in these countries as well as this thing, this commodity weakness we've seen, this slowdown in macro demand, slowdown in trade. We see it in China. We see it in places like Brazil. It's real, and it's starting to have a bigger impact. I think that continues.
Now, Greg, you've discussed Europe and also the U.S. Let's move over to Asia. I really want to get your take on what kind of impact over the next 6 or 12 months or so countries like China, India, and maybe even Japan could have on the gold market.
Well, significant impacts. And in the same vein as we're talking about Europe and the U.S., I think first down and then up. Why I say that is gold priced in Chinese renminbi right now is teetering on a technical precipice. It is very vulnerable technically. It is at major key underlying long-term trend support levels that are at risk of being violated. One of the things I find most interesting in China, here we look at a place that, hopefully they could take over as the engine of global growth. And hopefully, China has flexibility, which they do, to some degree fiscally and monetarily, but that China now, because they are easing monetary policy and cutting interest rates finally, that this is, our savior, this is a boon, this is going to be what bails us out is China. I don't see that, and I don't see that right now especially. Problem number one, China cutting interest rates is all well and good, but inflation is falling much faster than China is cutting interest rates. Thus, real interest rates in China are actually rising, and they're not only rising, but they're positive. So this is a problem in terms of, seeing the flow through from monetary policy. You have credit growth, you don't have the same economic dynamic that you've had in the past. Too much of its investment, less of its manufacturing, less of its exports, and import demand showed one of the biggest declines we've really ever seen in the most recent month. Across the board in commodities, we're talking volume, not value, so it's not a price dynamic here. It's a pure volume dynamic, and it is broad-based. We see it in a number of the leading economic indicators out of China. And when you see things like their 5-year interest rate swap below their official interest rate, that's telling. It's telling them they're not reacting fast enough. They're not being aggressive enough from a monetary policy perspective. And if you see a breakout to the upside in the U.S. dollar versus the Chinese renminbi, 638 is a key technical level. You have the 100-day moving average of dollar renminbi rising for the first time in years. This is a potential major move. Kind of tough to see how that's going to play out and what the catalyst is, in a driving force to a trend that's going to see real hardcore appreciation in dollar renminbi. But the fact of the matter is, it's appreciating for the first time in years, and it's very close to a major upside technical breakout, which could coincide with a breakdown in gold price of renminbi. And that's bullish for the dollar and is implying very much so that China is not going to be the savior here, that they're just not either capable or not willing to be aggressive enough to make that happen.
Now, we know that India is a huge buyer of gold, and you're talking about the price of gold and the renminbi. India, the price of gold there has actually been quite strong because their currency has been so weak. So is that, I mean, how do you see that playing out? Is that also kind of bearish for gold here in the medium term?
Well, I mean, India is a very interesting case in point, and yes, clearly because of the weakness of the rupee, gold in rupee terms has held up relatively well. It just recently tried, although it failed, to make a new all-time high. It has come off a little bit. It looks a little bit vulnerable, but I mean, when you stack up India against China, India looks much better. I mean, relatively speaking, to me. You have a country where they have cut interest rates. They're playing it off against their WPI, which is their main inflation indicator, the wholesale price index, which has allowed them to be a little more proactive. Their stock market is just now starting to diverge from the Chinese market in a fairly pronounced way. Just something I happened to be looking at the other day, and very noticeable to me. So I found that to be pretty interesting. And from a long-term perspective, keeping in mind that while we're kind of looking at some of these short-term negatives that we have right in front of us, from a long-term perspective, the situation in both China and India is potentially wildly bullish for precious metals, as it is for commodities in general. We had one of our clients ask us today, where is there a place to hide? Where can I put money to work here? And I say right now, maybe, there's not that many places. But when you get this next flush, I think commodities markets still offer great upside value, great risk-reward dynamics. They're going to print money. These are, rather than equities, as opposed to equities, commodities are still, markets that are in tight supply and demand situations in many cases, and can become tight if they're not very quickly, based on demand, based on hoarding, based on, more rampant price inflation when they start to push money again. And again, real economies are not going to absorb whatever money officialdom pushes when they push again, because real economies don't need it. Real economies are not healthy. They're not demanding new credit. They're not growing. So where that money goes will once again be asset markets. It'll be the same play as 2009, 2010. And I think commodities markets will be well positioned. China and India are major players here, and particularly in gold. I mean, you start to get more allocation, by the public, more allocation even by central banks, particularly the Chinese central bank, of their reserves into gold. It could be wildly bullish. And I'll throw one last curveball at you. I've always believed that some part of whatever the end game in Europe is going to be could involve some kind of massive central bank swap between the Bank of Germany, the Bundesbank, the Bank of France, and the Italian central bank, who have huge gold reserves. Relative to the percentage of reserves that China has, there could be some kind of wild, it would have to be creative. I'm not sitting here making up all the details, but I've always believed that somewhere along the line there's a major, currency, debt, and gold swap to take place between some of these big central banks, where China would end up taking European gold in return for also taking European debt off the books. So, when you think about what could be surprises that could be bullish for gold, China could be a major player in one of those surprises, and it could involve a central bank.
Greg, I want to get your thoughts on Japan. I actually have two questions. Number one, we know that Japan is probably going to have to basically destroy the yen to monetize their debt. So, number one, is that going to have anything more than a negligible impact on the gold market? In other words, could we see Japanese start to buy more gold? Secondly, I have my own idea that with the continuing sovereign debt crisis, and given that Japan is basically the worst offender, and given that their equity market has been in a bear market for so long, I have a thought that if there's a way to play this as far as picking one equity market, that it could be Japan. Now, am I totally wrong there? And number one, what's your thoughts on Japan and gold?
When you say pick Japan equity market, what's your perspective there?
Oh, well, my perspective is the fact that obviously Japanese have been buying the bonds there for so long, and that the country is going to have to obviously print a lot of money because they're the worst offender in the sovereign debt crisis, and because their debt has been building up so great, and their payments are going to be so huge over the next year or two that they're basically they're going to have to destroy the yen to deal with that, and that potentially people over there could see that happening, and then they put the money back into their undervalued equity market as a way to play that.
I don't know about buying the Nikkei, but I do agree with everything else you're saying. But that doesn't mean they're going to do it, unfortunately. Their debt is huge. They have, monetized some this year. They've sold some this year. They still have, $2.2 trillion worth just to roll over, let alone interest payments for the remainder of this year. That's a huge, huge number. You throw in another $1.5 trillion next year and $2 trillion the following year. We're talking, over $5 trillion in the next 30 months. That's a lot of debt. I'm surprised, to be honest with you, that we have gotten this deep in the year without it being a problem already. This was one of my things at the beginning of the year where I thought, here's a risk point that not many people are talking about that could be significant. It has yet to hit. The central bank, again, it's amazing sometimes how central banks can get away with doing nothing and looking like they're doing something. In Japan, they announced that they would extend their asset purchase program, which it was scheduled to expire at some point this year. I believe it was August. Well, they extended it, and that's all well and good, but they didn't increase the amount of debt they're buying on a month-to-month basis. All they did was say, instead of ending in August, we'll end in December. So they tacked on 4 months and announced a $200 billion worth yen increase in their asset purchase program, which really wasn't much of an increase, certainly not in the pace of purchases. That pace is going to have to pick up. I don't see how it doesn't. Yet, amazingly, the JGBs are at a new low yield. So it's a tough one to figure out. I do believe that it is, the rubber band being stretched, and when it releases, it's going to be violent. So this could be problematic. It's problematic in the sense that Japan is a net creditor nation. If Japanese rates start to rise, that's highly problematic in the sense that that money will now, be repatriated to the degree that it's not, at the very least, going out buying foreign bonds, which will put upward pressure on bond yields everywhere at a time when they may least be able to afford to go higher, particularly in Europe. So I think that this is still very much a wild card that could be played at any time. Frankly, I'm surprised it hasn't been played yet. I'm a little surprised they've been able to skate to the degree they have under the radar so far this year. Can they continue to do that? Maybe they can. I would be really surprised if they were able to, though, I got to say. I think this is still a story that will make headlines this year at some point.
Well, all right, Greg, you've covered so much today. I really appreciate your time, and I would urge our audience to seriously consider subscribing to any of your products. Can you tell us about the research products that you offer?
Sure. We do research in 3 areas. ETFs, we do the ETF playbook. We do the metal monitor, which is gold and silver focused. It's a once-a-week audio-visual report that I walk through charts and talk about the markets. It also, is published in PDF format as well. And we do the money monitor, which is our flagship product, top-down global macro. We'll talk about China. We'll talk about Europe. We'll talk about the U.S. We'll talk about Mexico, Brazil, Turkey, pretty much anywhere, or commodities, or currencies, or metals, or petroleum markets, really broad-based coverage. We also offer a 30-day free trial to any of the research, so any of your listeners can go to www.weldononline.com and sign up for the research. And we also operate as a CTA, so we offer a variety of managed accounts products. Our most recently introduced program is our metals-only program, which trades 7 industrial and precious metals. It's a 20-year back-tested track record with absolutely phenomenal results. Very, very pleased to be bringing this to the market at a lower minimum than we're usually accustomed to. We've had a lot of requests. We have high minimums in our discretionary programs. This is a $150,000 minimum, which is our smallest, and we're pretty excited about it.